G'day, Greg.
Woody, how are you, mate?
Good man. Normally I speak to you from the office, but I'm stuck as you are now. So I'm in my hallway of the house with the living room behind me, and just getting used to this new way of working again.
Yeah, well, I've been stuck for longer than you after I moved from Melbourne to try not to be stuck. So I'm used to it by now, mate. Although I must say, completely unrelated to our conversation coming up, lockdown in New South Wales is a little better than lockdown in Victoria, especially in winter. So there you go.
Well, saying winter, you just told me you were sat in your shorts, so about to go to the beach. So there you go. But look, a lot's happened this week, and you spent this week. We've moved our attention from one new monetary almost asset to a really traditional one, which is what's happened in the gold market. You've been trying to decipher what's been going on this week, and we started the week with a bit of a crash, I'd say. It was a big correction, actually. It started on Friday night, went through to Monday morning. But before I ask you about that, what's happened in the last year from August to August, really? Gold has done nothing, really. In the meantime, it's gone up, it's come down. But you said something weird's been happening lately. And I noticed the crash late last week and early this week. It happened at the same time that bond yields were continuing their decline too. And you noted that. You said that was a very strange thing to happen. Can you kind of explain that maybe to start our conversation off?
Yeah, I mean, there's a fair bit to get into. And with gold, you sort of sometimes can discuss the topic a little bit too simplistically, or you can get into the weeds too much and lose everyone. So we want to try and find a bit of a middle ground. So I guess the thing to keep in mind is that gold isn't a commodity, and it doesn't trade like other commodities that are based on supply and demand and in industrial strength and global economies. It's a monetary metal, and it is considered to be a very pure form of money, store of wealth, more than anything. And because it doesn't yield anything, it doesn't produce any interest, it tends to trade alongside other forms of money, such as US Treasury bonds, for example. So when Treasury bond yields decline, Treasury bond prices increase. And that means gold prices tend to increase at the same time, because as yields get closer to zero, gold becomes more of an attractive investment proposition, because if gold is a zero yielding product and treasuries are close to zero yielding, then obviously gold becomes a lot more attractive. So when you take inflation into account and you take inflation away from the nominal yields or the yields that you see in the papers and stuff like that, you get a real yield that these bonds trade on. So for the past quite some time, I don't know exactly when these bonds started trading into the negatives, but most yields are well into the negatives in terms of their real yield after inflation. So in that environment, gold should do very, very well. So you talked about August last year when gold peaked. At that time, there was obviously a lot of concern about the contraction in the global economy with all the COVID shutdowns. Bond yields plummeted, and real yields were deeply negative, and that caused a lot of money to go into gold, and it pushed the fundamental price of gold up, and it broke out to new all-time highs above $2,000 an ounce. Then when it became apparent that all the money that the central banks and the governments threw at the global economy to get things kickstarted, saw bond yields pick up again. So I think the US Treasury, let's just talk about the US Treasury yield, that reached a low in around August to July last year, and then it started to rise. Once that starts happening, the valuations for gold drops off. So gold has pretty much spent the last 12 months correcting lower. And what's interesting is that in the last few months, Treasury yields peaked in March and have been moving lower ever since. Gold has been up and down, and it's traded sort of, I guess it's tried to sort of rise in the same way that the bond yields have fallen, but it just hasn't really got any traction. And then on Friday, we had the news of the US employment data came out, and that was better than expected. And gold went from $1,800 an ounce to $60 an ounce. So it dropped $40 an ounce pretty quickly. And then for the rest of the Friday session, it just stayed around that level. There wasn't too much more to it. So that employment data was priced in pretty quickly. And at the same time, bond yields ticked up a little bit. So in some ways, you can justify that price change. But then on Monday, which was Sunday night, New York time, about 8:30, I think, Asian trading time, the gold price just plummeted from 1760 down to below 1700 an ounce. And when you look into the detail of the trading that happened there, and bear in mind, New York is closed. Japan and Singapore both had public holidays. So it was a very thinly traded period of the market, and all these contracts were just put onto the market, and it obviously triggered a lot of stop losses, which means that leverage positions had to get out, and the gold price plummeted down to, I think it got to as low as 1680 and then bounced back up, and it's currently trading around 1750. But compared to where it was, and for what everyone was positioning for, was this sort of move higher in gold, and gold has just been whacked lower. So I was sort of looking into that a lot this week, because when price moves are so extreme and they happen in these sort of strange times, they tend not to make a lot of sense. And I'm sort of trying to patch all that up together. So I did this I was doing a lot of investigation into it. And once again, without getting too much into the detail of because once you sort of start this rabbit hole, you can just keep going down it for a long time. But there is so much, I guess, interference in the system over the past 12 months. There's been the Fed's buying $120 billion worth of Treasury securities and mortgage-backed securities and pumping all these bank reserves into the financial system. Now, there's a lot of argument as to whether that's actually inflationary or whether it just all gets stuck in the system. But on the same or the other side of the coin, you've got governments that are just printing or spending huge amounts of money in their fiscal deficits. So there is a lot of money going through the economy and going through the financial system. And that's creating all these weird things in the financial system. And just in the past month or two, the Federal Reserve's reverse repo facility, which is hardly ever used, and when it's used, it's just used in the short term. Sometimes it absorbs a bit of money from the market. Sometimes it doesn't. It went and it started in 2013. That's when they first created this facility, just to try and control the flow of money in the system. That hit a high of over $1 trillion on the 30th of July. Now, the common thing that you'll read in the mainstream press is, there's too much cash in the system, so financial market participants go to the Fed and give them their cash, and the Fed gives them Treasury securities in exchange. It absorbs the cash. But there's another line of thinking that there is a shortage of collateral in the system. Now, collateral is something that secures short-term overnight loans, and without that collateral, the short-term money market ceases to function. And this is the whole foundation of the financial system. Without short-term money, which is interbank lending, so banks square their books at the end of the day, and there's a lot of money that gets passed around. This is a multi-trillion-dollar market. Without the collateral, it just doesn't work. So there's a school of thought out there that says there's actually collateral shortages in the system, which suggests there's a lot of underlying pressure in the financial system. And when you get these weird moves in gold happening around the same time as this is happening, then it sends a few warning signals to me, and it suggests that the gold is being sold in the short term. And whether I don't necessarily know if that means outright sold or, these financial transactions that are called swap arrangements to raise short-term US dollar liquidity effectively. So to wrap that all up, what I'm sort of thinking is this is a really good short-term opportunity if you're interested in getting into gold at the moment, because these counterintuitive moves don't happen all that often. And generally when they do, they're resolved in the next month or two by the market moving much higher. Now, if you're bearish on gold, then your view would be that the Federal Reserve, central banks around the world, governments around the world have done enough to create a self-sustaining recovery, which will see bond yields rise, which will see tapering of all the purchases they're doing, of all the monetization that's going on at the moment, and eventually, interest rates would rise again. My view is that is not going to happen. We've seen this thing play out before, and the the global economy is effectively in a debt trap, and the amount of new debt that was added to the global economy in the past 12 months is just massive. So to think that we can all of a sudden just get back to any sort of self-sustaining recovery, to me, is just crazy. And the market is buying it at the moment, and you have to respect that. And that might be the short-term narrative for a little bit longer. But I'm saying that I think this is, a really good opportunity if you've been looking to get into, gold stocks or increase your positioning. Gold stocks have been knocked quite heavily in the past week. Gold price itself is down. And I just think it's a great opportunity.
I'm going to come back to that point a little bit later, but first you said one of the key things you said on Wednesday actually was keep an eye on the exit. Now, I think you were referring to stocks in general, stock markets, were you, at that point? Because obviously everyone's a great investor on the way up and you know how to buy. Where successful investing really thrives is in these down markets. So what did you mean about keeping an eye on the exit? Because you mentioned it's a short-term opportunity to buy into gold. What was that? Where did that line of thinking come from?
Well, I guess there's two separate things. So the market has been just going up day after day, almost relentlessly for the past few months. We had a decent correction back in March, but really we haven't had much in the way of a clean out in the market. I'm not of the view that we're going to have another credit crisis or any sort of major deep correction anytime soon. But I do think that given we've just had so much stimulus put into the economy, that I wouldn't be surprised if we do see a correction anywhere from 10 to 20% in the next 6 months. So all I was sort of saying with that, keep an eye on the exits, is just be aware of the type of environment you're in. When things are this good, when the market goes up day after day, when there's loads of stocks that are doing well and everything seems to be coming off, that's when you have to be at your most sort of, I guess, heightened alert in terms of, if it's this good, where does extra upside come from? On the flip side of that, gold markets tend to do very well or tend to do much better in defensive investment environments. So it just sort of, you look at these disparities in the market. You've got the stock market up here that's outperformed for so long, and the gold market that's spent pretty much the best part of the past 12 months correcting and falling lower. I think it's a reasonable time to think about reallocating some money from the stock market into, and when I say the stock market, just generally stocks. If you've done well, if might be worthwhile taking some profits. I mean, one of the things that I wrote about to subscribers this week was, to think about how to position your portfolio a bit more defensively. And I'm not saying sell out. I'm not saying, you should just get out and sit in cash. There's ways that you can structure your portfolio just to prepare or be a bit more defensive. So really that was just about saying stock market's up here, gold stocks are down here. Maybe take a look at those two things and see whether a slight capital reallocation might make sense for you.
So the bull market is not necessarily over in your view, and this is a pretty good opportunity for the longer term for gold investors.
Well, I think the gold bull market, in as much as the stock bull market, is probably not over, and that comes back to things we discussed months ago with that life at zero story, is that central banks and governments are devaluing their currencies, and that is the only thing that they've got to do in order to try to dig these economies out of these debt traps. They don't really have anything else in the playbook. So to me, that's something that is not going to go away. You're going to see more extreme forms of that in the years to come. But right now, gold is looking like a much better value proposition than the stock market in general, purely because it has had a 12-month correction and the stock market has been going up relentlessly for 12 months. In 6 months' time, that might be a completely different story. But right now, I think that's where, the contrarian investor should be looking to position themselves.
Why do people tend to be skeptical or bag investing in gold? And it's the same with people that bag crypto as well, I guess. yet they have a lot of trust in things like the dollar. And when logically, the purchasing power of fiat currency has been just going down and down, and there's only one way it can go. It's not going to buy you more goods for less. It's hard to see that picture happening. What is it in the psychological makeup of people that find that quite a hard thing to get? You see it all over Twitter. I mean, people bagging gold, bagging Bitcoin in the same way. Yet it's patently obvious that there's only one way to go for paper currency, especially when the central banks are printing it ad infinitum as well.
Yeah, I don't really know. I think that the traditional response would be the Warren Buffett answer is that gold doesn't pay any income, and why would you own something? And look, to be fair to Buffett, he's spent his life investing in companies that generate earnings and dividends, and he compounds it. I mean, he's built his wealth around compound interest. You can't do that with gold. And I'm not saying that you should invest in gold at all times, because there are certainly times where productive investments are better. Gold does well, and I've made this point on a number of occasions. Gold does well in periods of monetary chaos. It's not about inflation. It's an inflation hedge. I don't think gold's necessarily a good inflation hedge. Gold is an inflation hedge against monetary chaos and against I guess it's insurance against some kind of monetary breakdown. And by that I mean, if you own a physical piece of gold, that is yours. There's no other counterparty on the other side of that. In the financial system, if you own a US Treasury bond, there could be 20 other claims on that Treasury bond because it's been on sold half a dozen times. The equity market, yes, you own the shares and there's no one on the other side of that, but there's counterparties that hold that for you. The equity market is a part of the overall system that's a highly leveraged system. So there are loads of risks out there when you're playing in the fiat money system, and there are times where you should be looking to own gold as insurance against that system, malfunctioning. And I think we are in an era, especially post 2008, we are in an era of that especially happening. And you've seen from 2008, we've made this point loads of times, the economy hasn't been able to stand on its own 2 feet. The Federal Reserve has constantly grown, and not just the Fed, I'm talking about all central banks around the world, have had to constantly expand their balance sheets just to keep things afloat. Now, that is not going to reverse. Like, the system is at a point where it cannot handle a reversal of that course. So to me, it makes perfect sense to own gold as an insurance policy. And I'm not talking about 100% of your portfolio. I think I recommended between 10 and 20% of your portfolio, depending on your conviction, depending on how much volatility you can withstand, to put that amount in your portfolio as an insurance policy. Now, if people decide that they don't need that, or they can't see how gold acts as that insurance policy, that's fine. But that's the rationale and justification that I use for it.
Yeah, and then of course, in that environment, it does feel like we are entering a period of complete unknown what's really going to happen. I mean, if you look at 100 years ago, in 1921, just fast forward 10, 15, or 15 years, the monetary system was entirely different. You had a gold standard, then you had the post-Bretton Woods era, or maybe it was a bit more because it was after the Second World War. But it does make you think, what's this transition going to actually look like? And it kind of makes sense, doesn't it, to have a bit of hard money, at least for a certain percentage of your portfolio. But then
absolutely
on the back of that, you've got the companies producing it. And, we might be feel I'm pretty unlucky at times being in Australia in a lockdown at the moment. But one thing we are really do have an advantage of over the rest of the world is our gold mining sector. And there's heaps of stocks, as you well know, that are based right here, producing, searching for gold. And I think we're close to becoming the biggest producer in the world. I don't think we're there yet. I think,
I think we might be. I don't. keep up to date with those stats too in too much detail, but I know we're either one or two, put it that way. And yeah, look, there's lots of great companies out there, and the ones that I look at, I've got some of the larger ones in my portfolio, and the amount of cash that they're generating at these levels and the valuations they're on compared to the valuations in other parts of the market, very, very attractive. And if you sort of use that logic down to the smaller end of the market, then there's going to be bargains there everywhere. I was just writing in one of our other publications for Rum Rebellion today, pretty much this issue, right? Like when you're in a period of where the market seems to be really sort of bubbly, and you're thinking, okay, where can I find value here? Where's something that is going to be good value for me to recommend or put my money or whatever? And I used not the analogy, but I used the example of how I was sort of looking for things at the start of the year, because it was a similar situation. We just had this big post reopening rally. The market had done really well. And at the start of the year, everyone was thinking, okay, well, there's going to be a correction and there's not much value. And I started looking at coal stocks. I thought, well, is there any more hated commodity than coal? Everyone thinks coal's going out of business. The coal price had dropped to massive lows because the global economy had shut down. And I recommended a stock called Whitehaven Coal. And, hopefully a lot of my subscribers got on it at that point. But I remember sort of writing, look, the reason why I like this stock is it has fallen 85% from peak to trough, and it started to turn back around. There are signs that, the environment is improving. But if you go and ask most people out there, they would say, coal, I'm not going to buy coal. Coal's going to be dead in 5 to 10 years' time. And I sort of looked at the data and the usage of it. Coal is going to be, whether you agree with it or not, coal is going to be around for a long time to come, because emerging economies everywhere, and China in particular and India, are building, many, many more coal-fired power stations that are being closed down in developed nations. So this,
I read somewhere in China that they're building one coal power station a month. Still,
it's crazy. And China are telling us that they're going to be what is it, net neutral at 2060. That's just bollocks. It's not going to happen. China will tell us what we want to hear, and then they'll go on and do whatever they want. So anyway, all these things played together to sort of look at some of these stocks, and coal stocks at the start of the year were perfect examples. And now you've got coal prices at near 10-year highs. You've got economies opening back up, and all these power stations that are being built are demanding our coal. So, as I said, whether you agree with it or not, that's where you've got to look for this value, where people are just thinking, nah, that's old news. And I think to some extent, gold is that story at the moment. I mean, if you look at the way that Bitcoin's reacted in the past month, I mean, it hit a low back in mid-July. A month later, it's up 50 something percent. Gold has struggled, and people are looking at Bitcoin and saying, well, that's the new gold. And look, to some extent, it does have many characteristics that are better than gold. And I wrote an update today to the new money investor, people saying that the difference between gold and Bitcoin is that gold was financialized by Wall Street decades ago, and there's mounds of paper gold that if you want to get exposure to gold, you can buy Wall Street's paper instead. So the amount of demand coming for gold is absorbed by the paper that Wall Street's thrown at it. Whereas Bitcoin, Wall Street haven't been able to get into Bitcoin and create paper Bitcoin in the same way they've been able to do that to gold. So Bitcoin is still in price discovery phase, but it feels like it's doing the job of what gold should be doing. Now, when more and more people think that, and bear in mind that gold is still an integral part of the financial system, then I think, okay, well, there's got to be an opportunity there. Sometimes you don't know what the catalyst is going to be to see the mood change, but you just know it's going to be there somewhere. And I think, I've followed the gold market for 20 years. So I'm reasonably confident that, within the next few months, we will see something that might change the balance there.
That's really interesting, because it's that comes back to what we said at the start, that the really great gains, the great investments, and the great investors are made in times when stuff's going down. When you've almost got to, what did our founder Dan Denning used to say? You've just got to hold your nose and buy, basically.
Yeah, look, it's not easy, and this is where portfolio allocation comes into it. If you're only risking 5% of your portfolio, it's a lot easier to do than if you're risking 30, of your portfolio. So, it comes down to what comfort level you have, but you've also got to be willing to not be too concerned about how you might look or what other people might think. You've got to look at, be really rational about it, look at it from a rational perspective. And that's all I'm trying to do at the moment. I sort of look at gold rationally and say, well, relative to many other assets, gold is now trading at quite attractive levels, and therefore it deserves, some allocation in your portfolio.
And it's partly why over the next week or two, we're going to start really focusing on that side of the market with another of our colleagues, Brian Chu, we're going to do a bit of investigation into the opportunities in the gold market and the pretty spicy gold miners and explorers that potentially look really, really good over the next, good to invest in now, good to trade now, and hopefully they pay off over the next 6 months to a year.
Yeah, I was going to say that end of the market is not one that I sort of, play in myself too much, but I think it is, a particularly interesting time to be doing that now.
And that's what our job is. That's what we try and do. We're trying to think what's the next 6 months to a year look like. It's all in the name, Fat Tail Investment Research. What's the fat tail investment of today? Seems like it could be gold. So we'll look into that. All right, cheers, Greg. We'll leave it there today. Thanks for the chat. I know you've been really, really busy this week. Old Brian Dintz is having a bit of time out to do, so you've been landed with a bit of extra work to do this week.
Yeah, I think I need some time off myself.
Hopefully it eases off next week. But thanks for your time.
No worries, mate. Take it easy.
Right. Take care. Thank you for watching.